welcome from 𝗥𝗵𝗲 and 𝗦𝗵. Welcome to our show. And 𝗦𝗵 and I always value you. We appreciate you for always tuning in, because you could be anywhere. You could be in your business, you could be at work, but you are choosing to join us today because 𝗦𝗵 and I want to give you more value. The more value we give to you, the more success you will have in business and in life. So welcome to everyone. Welcome to the show. And my name is 𝗥𝗵𝗲.
My name is 𝗦𝗵, and
welcome
to our show.
So 𝗦𝗵 is going to be taking over the conversation, and 𝗦𝗵, I'm going to pass the mic on to you.
Thank you, 𝗥𝗵𝗲. So today's topic is a continuation from the book of Robert Kiyosaki, Increase Our Financial IQ. What are we investing for? So I have about 13 lessons, key takeaway that I would like to share today. First lesson is most financial advisors, what they recommend us to do is invest in growth funds. And this is true if we are young, because we have time. Now, second, financial advisors would also advise us to invest in growth funds because when we invest for growth, that means we are investing for income when we are young. Time is on our side. Now, third key takeaway, financial advisors would advise us, we're older, so older, they would advise that we shift our investment from growth funds into income funds, also known as annuities. Fourth lesson, investing into income funds, also known as annuities. This means we're investing for cash flow. So that is when we are older. So a lot of times that's like the retirement age. That's their advice. Age. Fifth lesson, financial advisors, they believe that cash flow is less risky and more certain. When it comes to cash flow or capital gains, there are three general types of investors. In today's topic, I will be dealing on the first one. Now, seventh lesson. So those So these are now the three general types of investors. First, those who invest only in capital gains. Capital gains is again appreciation. So in the world of stocks, those people who invest in capital gains, you may hear background noise, and that's my husband. So those who invest in capital gains, they are called traders. They are called traders. Now, ninth lesson. In the world of real estate, which is Alka's world and my world, people who invest for capital gains, they are called flippers. They flip properties. 10th lesson. The investment objective for the capital gains investor is generally to buy low and to sell high. So to buy low and to sell high. That is the main objective. 11th lesson. When we look at Robert Kiyosaki's cash flow quadrant. Now, let me draw that again. So there is an E, which stands for employee. There's an S, which is self-employed. There's a B, which is the big business. And there's an I, which is the investors. This is the cash flow quadrant. Now, the traders in the world of stocks, right? In the world of stocks, and flippers in the world of real estate, they belong to the S quadrant. Okay. They belong to the S quadrant. They belong here. This is where the traders and the flippers belong. They are self-employed in the S quadrant. And according to Robert Kiyosaki, they are not investors. They do not belong to the I quadrant or the I quadrant. They belong to the S quadrant. Now, 12th lesson. Traders and flippers, they are considered professional traders and not investors. So that's the 12th lesson. 13th lesson. According to Robert, on top of that, so in the US, in our country, the traders and the flippers, they are taxed. Taxes. Remember, it's not about how much money you make. It's all about the money you keep. So the traders and flippers are taxed, and they are taxed at the higher S or self-employed quadrant. Now, if we remember the cash flow quadrant again, this is where the E, employee, this is the S, self-employed, this is the B, big business, and this is the I, investor. So what happens? The taxes in this category, in each category, differs. So the cash flow quadrant says, according to accountant 𝗕𝗏𝗏, the E, 𝗕𝗏𝗏 is the accountant of Robert Kiyosaki. So according to 𝗕𝗏𝗏, the E employee is taxed at 40%. The S or self-employed are taxed at 60%. The big business is taxed at 20%. Whereas, let me make this clear, they are taxed at 20%. Whereas the I or the investors are taxed 0%. So these are the different percentage that the employee pays, the self-employed pays, the big business pays, and the investor. And according to Robert, the traders and the flippers, they are taxed at the higher S or self-employed quadrant. So this is 60%. And second, Robert says they do not, the traders and flippers, they do not enjoy the benefits of the tax breaks. Remember, if you are an investor, just like Donald Trump, you get tax breaks. Donald Trump is an investor, so he enjoys a lot of the tax breaks, right? So when you are a trader or flipper, you do not enjoy the benefits of the tax breaks. The investor quadrant receives. So what they need to do in order to avoid tax, right? They roll it over, which means they buy another property, or in this case, or stocks, right? Stocks to the real estate to flip again. And in the world of stocks, so they buy more stocks, right? You have to push it again to another property or to another stocks to avoid the tax. Now, to recap on this 13 points from the book of Robert Kiyosaki, Increase Our Financial IQ. This is a continuation of financial intelligence number 4. This topic today is entitled, What Are We Investing For? Now, first lesson, most financial advisors would recommend, if you're young, to invest in growth funds. Why? Because investing in growth funds means investing for income. So you want that when you are young. So you have more time to ride the market, the ups and downs of the stock market. Financial advisors advise, if you're in the retirement age, if you're older, the financial advisors want them to shift from growth funds into income funds, also known as annuities. Now, investing into income funds or annuities means investing for cash flow. So this is their advice when you are older or in the retirement age. Now, financial advisors believe that cash flow, okay, the annuity or the income funds, the cash flow is less risky and more certain. So why is that? Because when you are old, you need to have money coming in. So the annuities or the income funds provide that to you. That's what they recommend. Now, when it comes to cash flow and capital gains, there are three general types of investors. I'll be talking on the first one. First one is those who invest only in capital gains. Now, in the world of stocks, the people who invest in capital gains are called traders. In the world of real estate, the people who invest for capital gains are called flippers. The investment objectives for capital gain investor, whether a trader or a flipper, generally is to buy low and you want to sell high. Now, you are doomed if the market is crashing or has crashed. You cannot sell it at a high price. Another lesson, when we look at cash flow quadrant, these traders and flippers belong to which quadrant? Let me talk about the quadrants first. So we have the E, or the employee. We have the S, or the self-employed, the B, the big business, and the I, the investor. So now these traders in the world of stocks and flippers in the world of real estate, they belong to the S quadrant right there. They belong to the S quadrant. And they are not investor. They do not belong to the I quadrant. Traders and flippers are considered professional traders and not investors. So on top of that, in our country, USA, traders and flippers, they are taxed at the higher S, or self-employed quadrant. So let me get back to the quadrant E, where you have the employee, S, self-employed, B, big business, I, investor. So according to Tom Woolwright, who is the accountant for Robert Kiyosaki, employees are taxed at 40%. If you are self-employed, such as if you're a trader or flipper, you are taxed at 60%. Now, if you're a big business, then you are taxed at 20%. If you're an investor, then your tax is 0%. So remember, traders and flippers are taxed at the highest tax bracket at 60%. Why? Because they belong in the S, or self-employed quadrant. And according to Robert, they do not enjoy the benefits of the tax break. They do not enjoy the benefits of the tax break that the I, or the investor quadrant, receives. So what they do is they have to roll over their money to buy another property or to buy another stocks, right? They cannot cash it and enjoy the cash. They have to roll it over to buy another property and stocks to avoid being taxed at heavy rate of 60%. Now, when you are, let's contrast that to an investor. So if you have control of the funds, of the assets, that means you have to control the funds. So to avoid taxes, now you remember, an investor, not really to avoid. If you are an investor, what you have to understand that the investor, because they do what the government wants them to do, they get the tax breaks. They do not avoid taxes. They pay their taxes. But because of this tax breaks, they're able to get the funds. They are able to get more money because of the tax deductions. Tax break, tax deduction. They can do cost segregation, bonus depreciation, right? These are some of the tax breaks that the investor gets. And remember, second point, in order for them, or let's call it the investors, to get the money, what they all just need to do is refinance. They do not have to sell the money. And when they refinance, this is tax-free. Okay? This is tax-free when they refinance. So by doing refinance, they still control the asset. They still own the asset. And it's providing cash flow every month. And they continue to get the tax breaks. So those are my lessons learned from today's topic from the book of Robert Kiyosaki. So let me know in the comment section below, what is your number 1 key takeaway and what can you implement from this topic that we discussed. So continue to watch Ria and Alka's show. Stay tuned for more.
That's great. Thank you, Ria.
You are welcome.
Give an example? Can you give an example when you talked about the growth fund? There were 2 points you mentioned. What are some of the examples of a growth fund?
Alka, number 1, I will tell all our viewers, our listeners, that I'm not into stocks. So majority of our money is deployed to real estate, 90+% of it. Now, when I invested my money as an employee and as a resident physician, I was doing what the Wall Street is doing. So what I did was I invested in S&P index fund. It's the general. I'm not investing into a single particular stock. So if you are interested in stocks, right, there will be a name that it's a growth fund, but you have to do your due diligence. S&P 500 may have growth fund in there. It's a compilation of 500 companies. That's why it's called S&P 500, right? That's in there. But if you want to be specific, then you can target your own. But if it's a fund, it's usually a composition of several stocks.
Yeah, I mean, like you said, it's more for like, it's more, sorry, what's that?
Oh, I can't help you there into the granular details of the growth fund because number 1, I'm not really into stocks. I'm more into real estate.
Yeah, no, that's fine. But it was just like a general idea, if you had an idea. But like I said, it's more for like the growth fund, like the index fund. They're more geared to like the younger people, because younger people, they have more. If they wanted to get into that, they have the tolerance for it. It's risky, but then you have the tolerance. Older people, you're more skeptical into, investing your money in that route, because it's risky and it's volatile, it's very the volatility. But younger people, for sure, they do get into that, absolutely. So, you know what? So that was just my question. And I think, guys, if you have any question, drop it in the chat, so that, we can respond back to you.
Now, the other thing, right? If they just Google growth funds, there's a lot. You will know because there's always like the last name growth fund. Now you have to do your own diligence as to which growth fund, because there's Fidelity. There's a lot of companies that provide growth funds. You just have to do your own diligence as to which one would provide you a much higher return. But like again, just like what Robert Kiyosaki says, the only way, if you want to pull out your money, you will be taxed at a high rate, right? Because then you're self-employed, you're going to be paying 60%. Whereas let's contrast that to a property that that you have. It's an investment property. So the way for you to get money is you don't have to sell it. You can get money if you refinance. Like I said, I'm not very familiar with stocks, but there's probably a way where they're not going to be paying the taxes to. I just don't know what term it is, but most likely the principle is to buy another stock, not really to take out the money. But let's compare it to what you and I do. I can have my money, right? I can enjoy, I can do whatever I want to do when the moment that I refinance the property. Now
Yeah.
I have the cash, I can use it wherever, whatever I want, whenever I want, right? For assets or liabilities, and that is tax-free. Now, 2, I still have control of the property because I still own it. I didn't sell it. I just took a refinance. 3, I still get the benefits, the tax breaks for being an investor.
Exactly. So, look into it, guys. The bottom line here is doing your due diligence, no matter what you are investing in, doing your due diligence, because that will save you a lot of time and money, for sure, a lot of money. So when you want to get into stocks, do your due diligence. What are the right stocks for you? Because everyone has their own goals, and then based on their goals, they will go and invest in those stocks. So doing your due diligence is what we are saying to you, no matter what you are investing in, is the bottom line. So guys, we have come to the end of another amazing show. Stay tuned always for 𝗥𝗵𝗲 show, and we will see you the same time tomorrow